Good evening investors and welcome back with me Madhveshwari on KleverStock, serving you the latest updates for the closing bell this evening. Kicking it off with the evening updates from Bursa Malaysia. Bursa Malaysia's benchmark index maintained its upward momentum through the mid-afternoon session today, buoyed by the sustained strength of crude oil prices. As the Middle East conflict continues to influence global commodity markets, the FBM KLCI climbed 5.27 points or 0.30% to reach 1,718.47 by 3:01 p.m. Despite a slightly softer opening, the index benefited from a surge in energy-related and plantation heavyweights, even as the broader market exhibited a defensive stance. The performance of the energy sector remains a focal point of investors, with crude oil holding steady above the $80 threshold and $85.13 per barrel. This pricing environment provided a significant lift to sector leaders, most notably Petronas Chemicals, while surged 72 cents to 4 ringgit 23 cents, and MISC, which gained 55 cents to reach 8 ringgit 79 cents. Other major gainers included Kuala Lumpur Kepong and PPB, which saw gains of 54 cents and 20 cents respectively, reflecting a rotation into commodity-linked equities. However, the gains in the main index masked a more cautious sentiment across the wider market. Losers outnumbered gainers 701 to 317, with total turnover recorded at 2.39 billion units, valued at 2.17 billion ringgit. While industrial and energy sectors thrived, the financial services index dipped, weighed down by marginal losses in major banking stocks like Public Bank and CIMB. Consumer and insurance counters also faced pressure, with Nestle and Alliance Malaysia appearing among the top decliners of the session. Analysts noted the market's resilience is largely concentrated in large commodity plays, as evidenced by the FBM Amal Sharia Index improving by 26.43 points, while the FBM ACE Index, typically more sensitive to retail sentiment, tumbled over 100 points. On the active list, Lotte Chemical and Valesto saw increased interest, while Capital A experienced a slight pullback. As the trading day nears its conclusion, the focus remains on whether the strength in energy and plantation indices can continue to offset the broader market's negative breadth. Now for some local economic news updates. Malaysia is maintaining a close watch on potential logistics disruptions as tensions escalate in the Middle East, though the government maintains that the overall impact on national trade remains under control. Investment, Trade and Industry Deputy Minister Sin Sin cautioned today that while global shipping routes face significant risk if the conflict involving the United States, Israel and Iran intensifies, the nation's diverse trading network provides a degree of resilience. Addressing a press conference, Sim acknowledged that the current climate is far from ideal for a global trading power. He stated trading routes may be affected and logistics disruptions are possible. Malaysia, as a global trading nation, could experience indirect effects. He also noted that some supply chain challenges have already surfaced, particularly regarding delays in the shipment of specialized products due to specific logistics constraints. Despite these hurdles, the Deputy Minister expressed confidence in the adaptability of the private sector. He suggested that logistics firms and industry stakeholders are already pivoting to find alternative solutions to bypass troubled corridors. Sim added that these challenges are being faced globally. Malaysia is part of the global trading system, so naturally we will feel some impact, but logistics companies will work around it. Everyone is trying to find solutions, so we remain cautiously optimistic. Statistically, Malaysia's direct economic exposure to the current conflict zone is relatively low. Trade with Iran in 2025 amounted to 2.45 billion ringgit, representing a mere 0.09% of Malaysia's total global trade. Exports accounted for 2.17 billion ringgit of that sum, while imports stood at 280 million ringgit. SIM further clarified that critical energy products like liquefied natural gas and crude oil are not among the primary items traded between the two nations, and that Malaysia remains in strict compliance with United Nations sanctions, limiting trade primarily to essential commodities like food. On a separate front, the government is also monitoring shifts in American trade policy. SIM revealed that officials are currently assessing the implications of Trump tariffs following a recent U.S. Supreme Court ruling. To address these concerns and seek clarity on the agreement on reciprocal trade, Prime Minister Datuk Sri Anwar Ibrahim is scheduled for a virtual meeting with U.S. Deputy Trade Representative Rick Switzer on March 10. SIM finally concluded the tariffs target importing companies in the US. We are reviving the situations and awaiting further clarity. Still on economic news, Bank Negara Malaysia Governor Dato Sri Abdul Rashid Ghaffar has affirmed that the nation's economy remains resilient despite a surge in global uncertainty triggered by the escalating conflict in the Middle East. Speaking to Bernama, the governor noted that while the situation is fluid and fast-moving, Malaysia is facing these external pressures from a position of fundamental strength. He emphasized that the central bank is vigilantly monitoring oil price fluctuations, potential supply chain bottlenecks, and the resulting volatility in financial markets. The conflict has already made its mark on global commodities, with crude oil prices jumping by more than $10 in less than a week to hover above the $80 per barrel mark. This shift has trickled down the currency markets, impacting the ringgit, which closed at 3.9415 or 3.9480 this past Thursday. Abdul Rashid observed, "We have also started seeing increased volatility in global financial markets, with many currencies affected, even the ringgit." However, he maintained that short-term market reactions to changing sentiments should not overshadow Malaysia's long-term economic stability. Supporting this outlook is Malaysia's robust performance in 2025, during which the economy expanded by 5.2%. This growth was driven by a combination of high electrical and electronics exports, a revitalized tourism sector, and strong domestic demand. The governor expects these drivers to persist throughout 2026, boosted further by the Visit Malaysia 2026 campaign and significant investment in data centers and artificial intelligence. He said that it's important for the years to press on with reform measures and make sure that the economy keeps on growing, noting that household spending remains supported by the steady wage growth and employment. On the policy front, BNM's Monetary Policy Committee has decided to hold the overnight policy rate at 2.75%. The governor described this level as appropriate and supportive of the current economic trajectory. While global inflation remains a concern due to energy costs, Malaysia's headline inflation stayed at a manageable 1.4% in 2025. Abdul Rashid added, the strong ringgit has helped to partially mitigate the impact. More importantly, targeted subsidies remain in place to help keep inflation contained, confirming that a more detailed assessment of global situation will be disclosed by the central bank later the month. Up next, we have some corporate updates. ICT Zone Asia Berhad has announced that its wholly owned subsidiary ICT Zone Sdn Berhad has secured a purchase order value at 17.75 million ringgit from FK Technologies Sdn Bhd. According to a filing, the stock exchange, the contract centers on the supply and delivery of specialized information and communication technology hardware with a specific focus on electronic display systems. The scope of the agreement is comprehensive, covering not only the hardware itself, but also the necessary supporting mounting structures and associated infrastructure. Furthermore, the contract encompasses a wide range of ancillary works essential for the full installation and operation of the systems. These include electrical works, ICT infrastructure development, professional consultant services, and the procurement of the required licenses from the local authorities. To facilitate the fulfillment of these substantial orders, ICT Zone Asia noted that it plans to utilize bank borrowings to partially finance the purchase of the necessary ICT hardware. As a result of this financing strategy, the company expects its gearing level to increase accordingly. This latest contract underscores ICT Zone Asia's capacity to deliver integrated technological solutions spanning from hardware procurement to complex on-site installation and regulatory compliance. The project is expected to contribute to the group's operational footprint as it manages the end-to-end delivery to these electronics display systems. And finally, wrapping it up with business updates. Nomura, Japan's premier investment bank and brokerage, has identified Malaysia as one of the few global economies positioned to gain from rising oil prices and robust domestic demand. In a research note released on Friday, the firm highlighted that Malaysia's status as a net energy exporter provides a critical buffer against economic shocks currently emanating from the US or Israel and Iran conflict. This unique position is expected to stabilize the nation's external balances even as geopolitical risks weigh heavily on other regional markets. The brokerage group pointed to a combination of energy exports and high-scale investment spending as the primary engines of Malaysia's continued resilience. Key structural reforms under the 13th Malaysia's plan alongside massive infrastructure undertaking like the Johor-Singapore Special Economic Zone are projected to keep growth momentum high. Nomura stated in the report that despite rising oil prices due to the Iran conflict, we think external balances and growth will be resilient as Malaysia is net energy exporter. Reflecting this optimistic outlook, Nomura has maintained its 2026 gross domestic product forecast for Malaysia at 5.2%, a figure notably more bullish than the government's official projection of 4% to 4.5%. This follows a strong performance in late 2025, where quarterly growth reached 6.3%. The export sector has also shown significant strength, with January figures leaping 19.6% year-on-year. Driven largely by the technology sector, sustained appetite for Malaysians made electronics. On the monetary front, Nomura anticipates a shift in the central bank's current stance. While Bank Negara Malaysia recently held the overnight policy rate at 2.75%, Nomura predicted a 25 basis point hike to 3% in the fourth quarter of 2026. This forecast is driven by expectations that core inflation will pick up later in the year, influenced by higher crude oil costs. Consequently, the firm revised its 2026 headline inflation forecast slightly upward to 2.1%. In a regional content, Nomura's assessment places Malaysia in a far more favorable light than its neighbors. The firm expressed caution regarding Thailand and Indonesia, noting that as net oil importers or countries facing fiscal deficits, they are more vulnerable to the current energy climate. While Malaysia faces risk from a potential global slowdown or a cooling technology cycle, Analysts believe the upside from higher commodity prices will likely offset these challenges. The bank added, "We pencil in higher subsidy and social assistance spending, which we expect to be offset by lower than budgeted gross developed expenditures, suggesting the government is well positioned to maintain its 3.5% fiscal deficit target." Well, that's a wrap for Closing Bell Updates with me, Madhveshwari. Thank you, investors. We shall catch up in the next session. Goodbye.